Why everything changes in your trading the moment you stop needing the money. I want to tell you something that sounds almost cruel when you're in the middle of struggling. The less you need the money from trading, the faster it comes. And the more desperately you need it, the more your rent, your bills, your self-respect feel like they're riding on this month's P&L, the further it runs from you. I know how that sounds. It sounds like something a rich person says to someone who isn't rich yet. It sounds like privilege dressed up as wisdom, and I understand if your first reaction is frustration. But stay with me, because this isn't about having money before you trade. It's not about waiting until you're financially comfortable to start. This is about something far more specific and far more transformable than your bank account. This is about the psychological state you're in when you sit down at the terminal. Because here's what's actually true. The market doesn't respond to your need. It doesn't care about your rent. It doesn't soften because your car payment is due Friday. It doesn't give you a pass because you've had a hard month. The market is completely, utterly indifferent to your situation. But you are not indifferent to it. And that asymmetry, your emotional stake against the market's total neutrality, is one of the deepest structural reasons most traders never break through. Today, I want to walk you through exactly what changes when the psychological weight of needing the money lifts, not theoretically, specifically, decision by decision, trade by trade. I want you to see the mechanism, because once you see it, you can start working with it even before your financial situation changes. And that, more than any strategy, will change your trading. Here's the belief the trading world never challenges. Most people believe that the path to profitable trading looks like this: study hard, find a working strategy, grow your account, eventually quit your job, and then, finally, trade without financial pressure. In other words, the relief from financial pressure is the destination, the reward at the end of the road. But what if that's completely backwards? What if the psychological freedom from financial pressure isn't the reward for successful trading, but actually the prerequisite for it? That reframe is not a minor adjustment. It turns the entire conventional model upside down. And the evidence for it is everywhere once you start looking. Think about every trader you've heard of who had a breakthrough, who finally crossed the line from inconsistent to consistently profitable. Almost universally, there is a moment in their story before the profitability where something released, where they stopped fighting for survival at the terminal and started simply executing. Sometimes that shift happened because they got a better job and the trading income pressure lifted. Sometimes it happened because they went back to demo for 3 months and the real money wasn't at stake. Sometimes it happened because they had a genuine psychological breakthrough, a moment of deep acceptance that made the money feel less urgent. The circumstances were different every time. The psychological shift was almost identical. And what I want to give you today is a map of that shift so that you don't have to wait for your circumstances to change before you can begin inhabiting the mental space where trading actually works. Because here's what nobody tells you. You can begin practicing that mental state right now in your next trade with your current account size starting today. Shift 1. When you need the money, you don't see the market, you see your bills. Let me be honest with you about what happens inside your brain when financial pressure enters the room. Your prefrontal cortex, the part responsible for rational analysis, long-term planning, and disciplined decision-making, starts to lose authority. The limbic system, your emotional brain, your survival circuitry, begins to dominate. And your survival circuitry does not care about your trading plan. It cares about threat elimination. It cares about closing the gap between where you are and where you feel safe. When you sit down to trade with financial pressure in the background, you aren't really looking at the chart in front of you. You are looking for the chart to save you, and those are two completely different acts of perception. The old behavior. You see a setup that's almost right, a B-grade setup. Under normal conditions, you'd wait, but this week you're down, and you need something to go your way, and this is close enough. You enter. It stops you out. Now you need the money even more. The new behavior. You see the same setup, you recognize it as B-grade. You wait. Not because you're cold or robotic, but because you genuinely understand that a bad trade doesn't just cost money, it costs the emotional stability you need to execute the next real setup cleanly. The psychology here has a name: scarcity mindset. When the brain perceives scarcity of money, of time, of opportunity, it narrows focus. You stop seeing the full picture and start scanning for the fastest exit from discomfort. In practical terms, this means forcing trades, lowering standards, and making decisions driven by what you need to happen rather than what the chart is actually showing. Think about James. James had $8,000 in his trading account. He also had $6,800 in debt he was desperately trying to eliminate. Every single morning when he opened his terminal, there was a secondary screen running in the back of his mind, which wasn't showing price action. It was showing numbers, obligations, deadlines, a quiet, constant hum of financial anxiety that sat behind every decision he made. When a trade went against him, he didn't just feel the normal sting of a loss. He felt the debt getting further away. He felt the timeline extending. He felt the evidence accumulating that maybe this wouldn't work, which meant the debt would never go away, which meant his life would never change. That's not trading psychology. That's survival psychology, and it produced exactly what survival psychology always produces in the markets: urgency, rigidity, and a complete inability to stay inside a disciplined process. The day James took a second job, not to fund his trading, but specifically to separate his survival needs from his trading account, everything shifted. The trading account was no longer his life raft. It was a vehicle, a separate thing with its own logic and its own timeline. Within 3 months, he had his first consistently profitable quarter. Nothing in his strategy changed. His account size didn't change. The market didn't change. His relationship with the money changed. The fastest way to get what you want is to not need it. Unknown. Here's the thought I want sitting deep in your mind. Are you trading the market, or are you trading your fear of what happens if this doesn't work? If that question landed somewhere real, drop a comment right now. Just type scarcity, because that one word might be the most honest thing you write this week. Shift 2. Needing the money collapses your time horizon. Here's something almost no one talks about. Professional traders think in hundreds of trades. Struggling traders think in individual trades. That gap in time horizon is not just a philosophical difference. It produces completely different behaviors at every decision point. When you need money from trading right now, this week, this month, each trade carries enormous weight. Each trade feels like it has to be the one. Each loss feels catastrophic, not because of its size, but because of what it means for your immediate situation. And when individual trades carry that weight, you do things to them that destroy their potential. You move stop losses to avoid taking a hit you can't emotionally afford. You close winning trades too early because the profit feels urgent and you're afraid of giving it back. You trade more frequently than your edge supports because sitting on the sidelines feels like wasted time when you need to be making money. The old behavior. This trade needs to work. I need to be right here. I can't afford another loss right now. Every decision inside the trade is filtered through that pressure, and every one of those filters degrades the decision. The new behavior. This trade is one of the next 200 I'll take this year. Its individual result is almost statistically irrelevant. What matters is that I execute it correctly. From that perspective, taking a small planned loss feels like nothing. Waiting patiently for the right setup feels natural. Closing a trade at your target, even when part of you wants to let it run, feels clean. The psychology behind this is what statisticians call the law of large numbers. Over a large enough sample of trades, a genuine edge will express itself, but it will not express itself in any given individual trade. Losses are part of the edge. They are the cost of doing business. The moment you truly internalize this, not intellectually, but in your body, in the way you feel when a trade stops out, you have crossed into a different kind of trading consciousness. Consider Sophia. She was a nurse, 6 years into trading as a side project. She traded between shifts, in the early morning before work, sometimes on her phone during lunch breaks. She never depended on the income. She didn't need it to cover anything. She'd allocated $5,000 to her trading account and decided clearly and deliberately that this was money she could lose without consequence to her life. She wasn't a genius. Her strategy was simple. Clean price action on the daily and 4-hour charts, 2 to 4 trades a month. No complexity, no indicators beyond moving averages. But she was consistently profitable, year after year. Not massively, but measurably, reliably, growing. When other traders asked her why she thought it worked for her, she always gave the same answer. I don't care if I lose on any individual trade. I only care about the year. That sentence, that simple, almost boring sentence, that is the sentence that separates the traders who make it from the ones who don't. In the short run, the market is a voting machine. In the long run, it is a weighing machine. Benjamin Graham. And the thought I want planted deep, what would your trading look like if every single loss genuinely felt like nothing more than a small, expected operating cost? Shift 3. The desperate trader takes setups the calm trader never would. This is where the practical destruction really happens, and I want to walk through it slowly because it's important. When you need money from trading, your brain starts doing something insidious. It starts making setups look better than they are. This is not a metaphor. Researchers have demonstrated that emotional states literally alter perception. When you are anxious, your brain is primed to find patterns, any patterns that justify the action it wants to take, which, when you're desperate for a trade to get back on track, means finding reasons to enter rather than reasons to stay out. The desperate trader sees a chart and asks, "Can I justify entering this?" The calm trader asks, "Is this actually my setup?" Those two questions look similar. They are not. The first is a lawyer's question, building a case for a predetermined conclusion. The second is a scientist's question, testing a hypothesis with honest criteria. The old behavior. The desperate trader enters trades with a 45% win rate, masquerading in their mind as a 65% win rate. They enter on B and C grade setups because they don't feel they can afford to wait. They trade in markets outside their usual area because something is moving and I need to be in it. They trade tired, they trade angry, they trade on the same day they had a big loss because waiting feels like falling further behind. The new behavior. The calm trader has a list of non-negotiable criteria, and those criteria don't bend. Not because the trader is rigid, but because they have genuinely learned, through painful experience, that every time they bent the rules, they paid for it. The criteria exist to protect them from their worst moments. Let me tell you about Michael. Michael was a trader with a good strategy and a destructive habit. Every time he had a losing week, he would lower his setup criteria for the following week. Not consciously. He didn't sit down and say, "I'm going to take worse setups this week." But in practice, that's exactly what happened. The setups he'd been waiting 4 days for suddenly started looking ready earlier. The confirmations he'd been waiting for started feeling like they were good enough. His risk per trade quietly crept up as the week went on. He tracked his trades for a year. The data was damning. His trades taken on days 1 through 3 of a losing week had a win rate of 61%. His trades taken on days 4 through 7 of a losing week had a win rate of 34%. Same strategy, same market, same trader. Different emotional state, catastrophically different results. When he finally saw that pattern clearly, really saw it in black and white numbers, he made one rule. After 2 consecutive stopped-out trades in any week, he was done trading for that week. Full stop, no exceptions, not a guideline, an absolute non-negotiable rule. His overall performance improved by 23% in the following quarter, not because he found a better strategy, because he stopped taking the trades that were generated by desperation rather than by his edge. Opportunities come infrequently. When it rains gold, put out the bucket, not the thimble. Warren Buffett. And the thought I want planted deep: how many of your losses came from setups you genuinely believed in versus setups you needed to believe in? Shift 4. Needing the money makes you unable to hold your winners. Here's the painful irony that lives inside financial desperation in trading. The desperate need for money doesn't just make you take bad trades, it actually prevents you from making full money on the good ones. When your financial pressure is high, winning trades feel like relief, and relief, by definition, is something you want to lock in as fast as possible. The moment a trade goes in your favor and shows a profit, every cell in your body wants to close it, take the money, make it real, stop the uncertainty. But trading success is built on asymmetry. Your losses need to be smaller than your wins. That asymmetry only works if you let your winners run, and letting winners run requires the psychological capacity to sit with uncertainty while you're in profit, which financial desperation makes almost neurologically impossible. The old behavior: trade enters profit. Internal voice says, close it now before it comes back. Trade gets closed at 30 pips of profit. Trade then runs 150 pips in your direction. Now you feel stupid, which increases the desperation, which makes it even harder to hold the next winner. The new behavior: trade enters profit. Internal voice still says close it now, but the trader has a plan, a hard target or a trailing stop method, and they execute the plan instead of the emotion. Not because they don't feel the pull, they feel it every time, but they have decided in advance what the trade will do, and they honor that decision made in calm rather than overriding it with a decision made in anxiety. The psychology is rooted in something called premature closure. When we're under stress, our brains seek the fastest resolution to the open loop of uncertainty. A profitable trade that's still open is an unresolved uncertainty. Closing it gives the brain the satisfaction of completion, but that satisfaction comes at the cost of the trade's actual potential. The big money is not in the buying and selling, but in the waiting. Charlie Munger. And the thought I want planted deep: every time you close a winner early, ask yourself, did you close the trade or did you close your anxiety? Shift 5. When the pressure lifts, your relationship with losing completely changes. This is the shift that underlies all the others, and it might be the most important thing in this entire video. The traders who consistently grow their accounts are not traders who lose less frequently. In most cases, they don't even win more often than struggling traders. What they do differently is lose better. They have a completely different relationship with a losing trade. It doesn't threaten their identity. It doesn't derail their week. It doesn't send them searching for the trade that will make it right. It simply is what it is, an outcome within the expected distribution of their edge, and they move on. This relationship with loss is not possible when you need the money. When you need the money, a loss is not a data point, it is a setback, a piece of evidence against the case you're trying to build that you can do this. It threatens not just your account, but your narrative, the story you're telling yourself about what trading is going to become for you. And you cannot lose well when losing means all of that. The old behavior, take a loss, immediately begin constructing an explanation for why it shouldn't have happened. Bad luck, slippage, the market was manipulated, the news was unexpected. Anything to avoid the loss feeling real and owned. Journal neglected, lesson avoided. The new behavior, take a loss, write 3 sentences in the journal. Was the setup valid? Was the execution correct? Was the risk appropriate? If the answers are yes, yes, and yes, the loss is a good loss. It was the right decision with an unfavorable outcome. This happens. Accept it. Close the laptop. The psychology here is what researchers call outcome independence, the ability to evaluate your decisions separately from their outcomes. This is critical in any probabilistic environment: medicine, investing, poker, trading, where the right decision can still lead to a bad outcome and the wrong decision can still lead to a good one. The trader who needs money evaluates decisions by outcomes. The trader who doesn't need the money evaluates decisions by process, and only process-based evaluation leads to real learning. Only process-based evaluation allows the edge to compound over time. The goal of a successful trader is to make the best trades. Money is secondary, by Alexander Elder. And the question I want living with you long after you close this video: if you evaluated every trade purely on the quality of the decision, independent of whether it won or lost, how would your trading change? The year Nadia stopped needing it. I want to tell you about Nadia. She had been trading for 4 years when she had what she calls the worst and best year of her trading life at the same time. The worst part, she lost her trading account, all of it. $15,000 over 8 months of increasingly desperate decisions that followed a string of losses she never properly processed. The details aren't important. The pattern is familiar to most traders who've been in this long enough. Losses led to revenge trades, which led to more losses, which led to position sizes that had no business being that large, which led to the kind of drawdown that doesn't recover. She was done, or she thought she was done. The best part started 6 weeks later when she took a job she'd been offered twice before and turned down both times because she was certain she'd be trading full-time soon. It was a project management role, good salary, stable, nothing glamorous. She gave herself one rule: she wouldn't trade again for 6 months, not because she was punishing herself, but because she needed time to be honest about what had actually happened. Not the trades, not the strategy, not the market, what had happened inside her. She spent those 6 months reading everything she could find, not about trading strategy, but about trading psychology. She read about the neuroscience of decision-making under stress. She studied how professional poker players managed variance. She read interviews with consistently profitable traders and looked not for their strategies, but for the mental frameworks they described. And something became clear to her that she hadn't been able to see while she was inside the storm. She had never, for a single day in 4 years of trading, actually believed in her edge. Not really. Every day she sat down, there was a quiet, constant voice asking, "Is this actually going to work, or am I just fooling myself?" That doubt, that low-grade, chronic doubt, was the invisible hand on every decision she ever made. It was why she moved stops, why she closed winners early, why she sized up after losses. Not because of any external factor, because she was trying to force certainty from a probabilistic game, and that is always, always, always impossible. When she started trading again, 6 months later, with $3,000 of savings she genuinely felt she could lose without consequence, she did one thing differently. She had written on a single index card her strategy, the entry conditions, the risk rule, the target rule, and at the top of the card she had written one sentence that sounds simple but had taken her months to actually believe. "My edge works over time. Individual trades are irrelevant." She taped it to her monitor. The first month, 2 losses, 1 win. Small negative month. She didn't spiral. She wrote in her journal, she reviewed the trades, they were all clean. The plan was followed. The results were within normal variance. Second month, 3 wins, 1 loss. Positive month. Third month, 2 wins, 2 losses. Roughly break even. Fourth month, 4 wins, 1 loss. Best month she'd ever had. She wasn't a different technician, she wasn't using a different strategy, she wasn't smarter or more experienced in any conventional sense. She was a different person at the terminal. Specifically, she was a person who no longer needed the trade to save her, who no longer needed the month to prove something, who had finally, truly separated her self-worth from her trading results, and the moment those two things became separate, her self-worth and her trading results, everything changed. That's not a metaphor, that's what actually happened, and it can happen for you. Not eventually, not after some magical threshold of account growth. It can begin in the next trade you take, if you're willing to do the internal work that makes it possible. Let me be honest with you about something now. Everything in this video, every shift, every insight, every story points toward the same root transformation. It's not about becoming a more skilled trader, it's about becoming a less desperate person in front of a trading terminal. And I want to be careful with that word, desperate. I'm not using it as a judgment, I'm using it as a description of a psychological state that most of us enter at some point in this pursuit. The state where the outcome of trading is tied too tightly to something that feels survival critical, our income, our identity, our sense of possibility, our proof of worth. That state is the invisible tax on every decision you make. And the work, the real, deep, unglamorous work of becoming a consistently profitable trader is the work of removing that tax, of creating genuine separation between what you need and what you trade. This is identity work, not strategy work. It asks questions like, who am I if this trade loses? What do I actually believe about my ability to do this? What am I really afraid of? What would it feel like to trade without needing anything from the trade? These are questions most trading educators don't ask you to sit with, because they're uncomfortable, because they take longer than learning a new indicator, because there's no simple answer you can write in a notebook and follow as a rule. But they are the questions that separate the traders who eventually make it from the ones who spend years technically learning without truly arriving. Imagine becoming a trader who opens the terminal in the morning the way a surgeon approaches an operating room. Not excited, not anxious, prepared, calm, ready to execute a skill they've practiced inside a process they trust, with an outcome they've accepted in advance, whatever it may be. Imagine becoming a person whose financial life is structured well enough that the trading account is a vehicle for growth, not a lifeline for survival. Imagine sitting with a losing trade, really sitting with it, watching it move against you, and feeling no more than quiet attention, no fear, no urgency, no internal voice saying, please, please reverse, just observation. And then, if the stop is hit, a calm note in the journal and a closed laptop. That trader exists. They are real, and they were not born that way. They built it. One honest conversation with themselves at a time, one rule honored under pressure at a time, one loss accepted cleanly at a time. That is the direction, that is the work, and you can begin it. I want to bring everything together now and leave you with something that lasts beyond this video. We started with a truth that sounds almost unfair. The less you need the money, the faster it comes. And by now, I hope you understand what that actually means. It doesn't mean you have to be wealthy before you trade. It doesn't mean financial pressure disqualifies you from succeeding. It means you have to do the work, the honest, specific internal work of building a psychological relationship with trading that doesn't run on need. Because need distorts perception. It collapses time horizons. It makes bad setups look good and good winners impossible to hold. It turns losses into identity threats. It makes the entire enterprise of building a trading edge nearly impossible, not because you aren't skilled enough, but because the emotional architecture underneath the skill is built on sand. The shift described in this video is available to you, right now, in your next trade. Not by pretending you don't have bills, not by denying the pressure that's real in your life, but by making a deliberate, conscious decision to evaluate your trading on process rather than outcome. By building the structures, financial and psychological, that separate your survival needs from your trading decisions. By asking every single session, am I trading the market or am I trading my fear? And by answering that question honestly, every time. You are closer than you think. Not because your strategy is almost ready, but because the awareness you're building right now, the self-knowledge, the willingness to look at the inner architecture of your trading, is the actual foundation of everything. Most traders never get here. They stay in the strategy loop forever. They keep searching outside themselves for the answer that was always inside. You're already doing something different. Trust that. Keep doing it. Be patient with the timeline. The market has been here for 100 years. It will be here next month, next year, a decade from now. You have time. What you don't have is the luxury of continuing to trade as the wrong version of yourself. Become the right one honest decision at a time. He who knows others is wise. He who knows himself is enlightened. Lao Tzu. If something in this video moved something real inside you, if you recognized a pattern, felt a shift, or heard something you needed to hear, I want to ask you one thing. Don't let this be a video you watch and forget. Subscribe right now. We don't talk about hot setups here. We don't chase trending pairs or sell the idea that the next strategy will fix everything. We talk about the real work, the deep work, the work that takes longer but lasts longer. If that's the work you're here to do, subscribe, turn on the notification bell, because the next video continues this conversation and you don't want to lose the thread. And share this. Send it to one trader you know who's stuck, who keeps changing strategies, who keeps studying but can't break through, who is fighting the market when the real fight is somewhere quieter. They need this conversation. You were ready for it today. And I'll see you in the next one.